At 29, Jake thought he had finally figured out how to build wealth. He wasn't rich. He didn't come from a wealthy family. And he didn't have millions sitting in a bank account. He was just an ordinary guy with a steady job, a few years of savings, and one big goal: become financially independent. For years, Jake had heard the same advice. Buy real estate. Let your tenants pay the mortgage. Hold the property long enough, and you'll build wealth. So Jake started looking. After months of searching, he finally found a small house in a growing American city. The asking price? $350,000. Jake ran the numbers. The neighborhood looked promising. Demand for rentals was strong. And based on the rent he could charge, everything seemed to work. Mortgage? Manageable. Rent? Enough to cover most of the monthly costs. Potential profit? It looked pretty good. Jake felt like he had found his opportunity. So he made the decision. He bought the house. And for the first few months, everything went perfectly. A tenant moved in. The rent arrived every month. Nothing major broke. Jake watched the payments come in and started feeling something he hadn't felt before. Confidence. He began imagining what could happen next. Maybe one property could become two. Two could become four. And eventually, he could replace his job income with rental income. He thought he had discovered the formula. But then, reality showed up. One morning, Jake got a call from his tenant. The air conditioner wasn't working. The repair cost him hundreds of dollars. A few weeks later, there was a plumbing problem. Another unexpected expense. Then came the property tax bill. And insurance wasn't getting cheaper either. Jake looked at his monthly numbers again. The property was still producing rental income. But the amount he was actually keeping was much smaller than he expected. Then came the month that really changed his perspective. The tenant moved out. Suddenly, Jake had an empty property. No rent. But the mortgage was still due. The taxes were still due. The insurance was still due. The bills didn't stop just because the house wasn't generating income. For the first time, Jake realized something important. He hadn't bought a passive income machine. He had bought a business. And every business has costs. That's where many new real estate investors make their first mistake. They see the rent, but forget about everything standing between the rent and the actual profit. Mortgage, property taxes, insurance, maintenance, repairs, vacancy, property management, and unexpected expenses that nobody can predict perfectly. A property renting for $2,500 a month doesn't mean you're making $2,500 a month. That's revenue, not profit. And that difference can completely change the investment. Jake started doing something he should have done before buying the house. He stress tested the numbers. What happens if the property stays vacant for 2 months? What happens if repairs cost $5,000? What happens if insurance increases? What happens if the neighborhood stops growing as quickly as expected? What happens if the property value falls? Suddenly, the perfect deal didn't look quite so perfect. But here's the interesting part. The house itself wasn't necessarily a bad investment. Jake's problem was that he had looked at the opportunity without fully understanding the risk. And that's a lesson that applies far beyond real estate. Because when an investment looks easy, that's usually when you should start asking harder questions. Today, investors have another tool that Jake didn't have when he started. Artificial intelligence. AI can analyze huge amounts of information in seconds. It can help compare properties, study local market trends, estimate potential rental income, calculate different scenarios, and even help investors identify expenses they might otherwise overlook. Imagine being able to ask, what happens to my cash flow if rent falls by 10%? Or, what if this property stays vacant for 3 months? Or, how would the investment change if interest rates moved higher? AI can help you explore those scenarios much faster. But there's a catch. AI doesn't know the future. It can analyze information. It can recognize patterns. It can help you ask better questions. But it cannot guarantee that a property will make money. And that's why technology shouldn't replace judgment. It should improve it. The smartest investors aren't looking for an AI tool to tell them, buy this house. They're using technology to understand why a property might be worth buying. And what could make that decision go wrong. Jake eventually figured that out. He didn't give up on real estate. He simply changed the way he looked at it. Instead of asking, how much can this property make? He started asking, what could go wrong? Instead of looking at the best case scenario, he started looking at the worst case scenario too. And that changed everything. Because successful investing isn't about predicting the future perfectly. It's about being prepared when the future doesn't go according to plan. Real estate can build wealth. But it isn't magic. A house doesn't automatically become a great investment just because someone calls it a great deal. The numbers have to work. The risks have to make sense. And the investor has to understand what they're actually buying. So the next time you see a real estate opportunity that looks almost too good to be true, don't just ask, how much could I make? Ask, how much could I lose? Because sometimes, the most important number in an investment is the one you didn't think to calculate.